Yo, what's up guys? It's your boy Looney. Today I'm breaking down the options selling strategy I wish I knew when I first started investing. If I had this one tool in year one, I would have saved myself from many bad entries, FOMO buys, and random trades. So let's talk about it. But before we get into it, quick shout out to the Discord. It is free to join, and then I also offer a premium membership. It's $8 a month, and it gives you access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. All the links to that are in the description. But when I first started and was a beginner at investing, I was all about buying stocks and trying to flip options fast by doing calls, lotto plays, and sort of hype trades. But what I didn't realize is that selling options, not buying them, can actually work way more in your favor if done right. I would have avoided overpaying for stocks and instead got paid what we call is a premium to potentially own them. And we're gonna run through an example. So let me pull up Oscar as my example that I'm currently doing with cash secured puts. And that's the first move I wish I knew. And that is selling cash secured puts. So let's say there's a stock like Oscar, and instead of buying it at what it's at now, or even what it was a couple days ago, I could sell a put. And it's very similar to like a limit buy where you're setting a price target at which you're comfortable owning the stock at. So I have a bunch going on. So I have $15, $12, $11, and $10. And this just means I'm agreeing to buy the stock at these prices only if it drops to that level at the expiration date. And in return for doing these sort of plays, I get paid a premium up front. So on this $15 one, I got $85, and I opened this trade up a few weeks ago, and the other trade's very similar, different premiums around $50 to $60 each. So you could see how quickly these add up. Now, if the stock doesn't drop to these price levels, I get to keep that money. So you see that 4,800, it's really more like, it's probably a little bit more than 4,800. Actually, no, I think it is correct at the 4,800, but I get to keep that money. So that money is returned back to my account, and I could use that 4,800 for something else, or I could just sit it in cash and earn interest. So it's really could be a win-win, because if the stock drops, I get to buy the stock for cheaper. And I get to still keep that premium, that $85 along with the others. Like this $12, I got $60 to open this. So I get to keep that premium no matter what happens with the stock. So it really is sort of a win-win. And this sort of gives you a built-in discount and forces you to wait for your price. You're more in control, and you're not just chasing green candles. Because beginner traders would have seen this massive jump back in June and thought this is a great stock. It's going to go to $100. But me, myself, I realized that there was a massive drop early on in July, and it continued to drop because of all this news with the headwind and the big beautiful bill, or the ACA subsidies. And there was just a lot of bad news going on and a lot of bad guidance. And even recently there was pretty bad guidance that they were saying that there was a net loss, I believe. And you can see here, analysts are rating it a sell. But I did my research, and I noticed that there was room for growth, and they were going to be able to overcome these obstacles on a long term. And that's another thing. You need to have a stock that you're okay with owning, and you feel good about it long term. With selling cash secured puts, you can do quick flips like meme stocks, like maybe Open or GameStop. But really, these aren't long-term plays. Because if we look at something like Open, this is really a flip of the coin. And you could do a buy call, whatever you want to do with this. But I would be staying away from this selling options because of how much of a gamble it is. Today it is down 23%. And as of now, it's not even meeting listing standards. So you need to make sure when you're selling options, selling puts, it's stocks that you want to earn and you like them. And that's what I was doing with Oscar. Oscar was a stock that I like to own. And that's a really good thing to learn, is choosing stocks, choosing what is the right stock. And I did this with SoFi. SoFi sold cash secured puts. Riot, I did it as well. And Mara. Mara is one that is facing a lot of backlash because they're selling off their shares. You can see today it is down 5%. But again, another stock that I'm okay with owning long term. It is still above my cost basis. If it continues to drop, I will just simply either buy more or just hold it. I'm in it for the long game. And that's really what's key, is to have that patience. Now, here's a little trick that is really good with selling options. And I sell puts that are out of the money. So out of the money with selling options. With other different setups or strategies, it's a little different what selling options or what out of the money means. But when you're selling a cash secured puts, all it means is that you're selling at a strike price that is lower than the current price. So if we go to trade options, and we go to any kind of expiration is when the contract expires. So it kind of tells you what's going to happen. Either you're going to buy the shares for the strike price, or you're going to get your cash back. Either way, you get that premium. That initial premium goes into your buying power. But out of the money is everything that is below the current share price. So all these $15, $14, $13 are all out of the money. And that's really key with selling options or selling cash secured puts. You want to be doing out of the money. And also, you want to have low delta. So delta does go with the price. So if the stock drops $1, that means that the contract will either increase or decrease by whatever the delta is. So that 0.24, if the stock drops, that means that the contract will increase by 0.24. And that changes. So that changes over time. Not the most important part of delta with selling options, or at least what I believe. And another thing with delta is that it actually kind of tells you the chance of profit. So if you notice, delta and chance of profit, if you add them together, they sort of equal 100, not exact, but delta also tells you the chance of the stock going in the money. And as we discussed, in the money, you get acquired those shares. So it's really not a loss, but you just end up owning the stock at a higher price than what the stock is at the time. So delta is pretty helpful, and you want to be choosing 0.2 to 0.3. I like choosing low, especially with Oscar being a risky stock and a volatile stock. So I have about an 80% chance of winning. So if we do something like this $12 one, this one's actually less than a 0.2 delta, but still is a high IV. So you can get really good premiums. You can get $45 just from doing this trade alone. And the way you lose this trade, if the stock goes to zero, and for it to go to zero is very unlikely. Another thing that I like to do is wait for red days. So I wasn't rushing in to sell options on this green period, this green 1 to 2 weeks. Instead, I waited for that pullback. I waited for the stock to dip and sort of the euphoria to cool off, and that's when I sold the puts. You get higher premiums with doing that, and also less likely to get assigned. But that's what I like to do when I sell cash secured puts. And I only sell puts on stocks I want to own. Again, think about Oscar, SoFi, and Riot. Riot, I'm not selling any cash secured puts right now. And you can see it's a red day, so you might be thinking, why not sell puts? But that's because my average cost is really low. I don't want to increase my average cost. So it's at $9, and I'll only sell cash secured puts if it starts getting closer to my average cost, and then I can sell it at lower strike prices. Additionally, my diversity, I'm at 26%. So I don't want to overdo it with being in one stock. So holding off on selling cash secured puts on this stock, and similar thing going on with Mara. This one's not a massive position in my portfolio, only about 8%, but my average cost is lower than that $17. So I'm going to wait a little bit for those stocks to pull back even more. If not, I'll keep selling covered calls. That is another strategy I go over, but I'm just going to hold it and wait for things to play out. Same with SoFi as well. So you're basically dollar cost averaging with income, especially with Oscar. If all these get assigned, my average cost will be somewhere in between that $15 and $10. So I'm essentially dollar cost averaging, but also getting paid to do it. So yes, this strategy is boring. It's slow, but it works. It keeps you disciplined, reduces FOMO, and builds positions at prices you actually like. And most importantly, you get paid to wait. In year one, I wish I focused more on this instead of trying to time everything. So selling puts and later cover calls once you get the shares creates consistent income and smooths out your returns over time. So that's the option selling strategy I wish I had on day one. If you're early in your journey, seriously, you should be learning these skills early. It's a game changer. Smash that like if you're building with strategy. And if you want to see how I'm doing this in real time, check out that premium membership. The link to that